The ASX is at all-time highs, but shares of market darlings like Pro Medicus are down 20%. Temple & Webster's down 30% at the time of recording this podcast. Across the world, there are major technology companies being sold down. I'll tackle that and more with Drew today as we go through your questions and some of the companies that are already reporting results. He's also got some hypothetical questions to throw at us. Stay tuned for this episode of the Australian Investors Podcast. As you know, Term Plus recently came on as a platinum sponsor of Rask podcasts, and I invested a small amount myself, $2,000 to be exact, to get a feel for it. After all, I couldn't tell you to consider it if I hadn't at least considered it myself. And the result is it's a very, very good platform. It's potentially the simplest technology platform that I've come across in Australian finance. And what makes that extra special is, behind the scenes, something very sophisticated is actually happening. Term Plus is investing your capital in a globally diversified and professionally constructed portfolio of private credit designed to produce attractive and reliable monthly income. Aside from providing passive income, what really attracted me to partnering with Term Plus now is potentially falling interest rates. Because Term Plus starts by targeting 3% returns above the RBA cash rate for a 1-year fixed term account, there's a buffer in place even as interest rates fall. Monthly income can also be paid directly into your bank account or reinvested for compound returns. I see Term Plus as a really neatly packaged way for retirees or even accumulators like me to get exposure to professionally constructed global private credit portfolios. You can find out much more information and grab a hold of the PDS and TMD at termplus.com.au. If you want to just check out the website, you should also know that there's an instant chat function for questions, which is really important and I find really handy before I invest in anything. Don't forget to tell them Rask sent you. And as always, consult a licensed and trusted financial planner who can take into account your financial goals, needs, and risk appetite before investing. What did you say Temple & Webster's down?
27, I think potentially 30% now.
And how much is the other one?
Do you know why it's down 27 or 30%?
No.
Discounting.
Oh, okay.
32%. But I thought, maybe, correct me if I'm wrong here, but Temple & Webster already discounts when you buy furniture on Temple & Webster?
Yeah.
Does that mean additional discounting?
There's a lot of discounting.
Discounting. It does feel like everything is on sale every time you go shopping for anything now.
It does.
Valentine's Day sale. I'm sure you've been loading up this time of year as well.
Yeah, well, I think we're already recording, so sure. Yeah, I've been really thinking about that. Thanks for reminding me, though.
Happy Valentine's Day.
Thank
this
you,
is
sir.
Get published on Saturday morning, so.
Oh, yeah, it is.
Yeah.
Oh, wow.
Yeah.
Temple & Webster down 32%. WiseTech down 7%. Pro Medicus down 22%. CSL fell 12% yesterday.
Yeah, we won't. We don't talk about that one.
What absolute dog. Someone called that a great buy. I think you were saying...
Not yet. I didn't say quite yet.
It's down 7% today. That means it's down 20% in 2 days.
Quite yet. Not a buy yet. AMP down 31% on Thursday after another report. It's been... I mean, this is...
What the F?
Is it
CBA's up 5% today.
I know. I've got another bet on CBA. I'm going to double up on this one.
CBA is up 5%. ANZ's up 8%.
ANZ all-time high for ANZ.
That's a dog as well.
They're loving the Nuno magic.
They just gutted it. BHP...
he's ahead on profit expectations. And this is shocking because he's sacked so many people as soon as he walked in the door.
Well, that's... Yeah. Just fire 1,000 people. There we go. Some profit.
There you go. Give the shareholders what they want.
Give it to
Give the RBA what they want.
Westpac, even that thing's up 2.5%. NAB's up 2%. Wow.
And this is why
BHP's 2%.
The market's at an all-time high today. Maybe it's just come off, but it was at an all-time high during the day. But at the same time, you sent an email this afternoon too.
Yes.
At the same time, there's headlines of wipeout everywhere.
Yeah.
So we're hitting all-time highs while seeing wipeout after wipeout after wipeout. Have you seen this before?
I don't think I have.
It's happening in the US too. It was, I think, listening to our friends over at
Animal
Spirits. Yeah, I think there was something like 337 of the S&P 500 companies were actually up in December, January. Like the broader index is actually going up, but there's massive sell-offs in individual companies. Do you think it's AI that hit TPW or?
I haven't looked at the result. I had a skim read of the article written on our website by Jazz Harrison, but Revenue was up from memory.
Revenue's up, profit was minuscule, but I mean, this is low margin businesses. I think JB Hi-Fi makes like 4 or 5% profit margin.
I think it's. I was thinking about this last week. There was volatility last week. I think people are just, for the first time ever, people have realized that software is not a guaranteed moneymaker.
Yeah.
For the last 30 years, betting on software companies has basically worked.
Depends on the software company.
Yeah, but like as long as it's like good software, people were always like, well, how could you not make money if a company is using your software, like a CRM, like a Salesforce? And now everyone's like, actually, maybe not.
I can just vibe code it myself.
Just wake up tomorrow.
Apparently you can make your own app now. Like you could just make your own app.
You could do whatever you want.
In like eight minutes on Anthropic or
there you go.
Whatever it is.
4 seconds.
I don't know how.
Just point and shoot.
I don't know what you do with it after you've made the app, but...
I did make this comment on X a little while ago that you could probably just point and shoot in the future. Yeah. So like a camera, a digital camera, and you just go, I just want that. And then like it just makes it. It just blinks. It's like, here you go, Drew.
See where you open the glasses in, yeah. Seems like it could work, but there's trouble. I mean, there's pressure everywhere, isn't there? Pro Medicus,
the mighty
today as well.
Pro Med, which is probably, I think, one of the highest quality companies on the ASX. Of course, I'd say that because I own it.
And it's not just a tech sell-off, though. It seems like it's just kind of company specific. Who's being impacted by what?
Well, Pro Medicus is down 22%. Here's the
22.
results for today. We're recording on Thursday. Revenue up 30%. Underlying EBIT up margin up to 73%. So that's the profit margin of 73%. Why did they do underlying? Because if they did the actual reported EBIT, it would look way too high. Because they put a couple $1 million into 4DX Medical, and it's now worth. They just wrote it up $150 million. So reported net profit was up 230%. Dividends are up 28%. Very strong sales pipeline. Now have over $1 billion of expected revenue over the next 5 years. Had a record half of sales last year, and shares fell 22%.
Can you explain that to me? I don't understand how that happens.
Well, because everyone thinks that vibe coding, Claude, will just replace Pro Medicus software. I think...
Can you explain what vibe coding is?
Yeah, so vibe coding is where you don't have to actually know coding. You can just tell it what to do.
Yeah.
You can just say, hey...
Can you create a website?
Create a website, and it will create some. Which is fine for that kind of basic stuff.
Yeah.
But then for more advanced things, basically any AI is trained on a lot of data.
Yeah.
So if you don't have a lot of data, a good example would be like if you want to build a website, there's like 1 billion websites. Yeah. So it knows how to build a website because it can just be like, oh, cool, I'll just study those other guys.
Copy that.
But if you have to study, if it's only got one thing that it could study, like Pro Medicus' software, but Pro Medicus hasn't made that code available, then it won't know. It will just be guessing.
Yeah.
And so it would be a lot more inaccurate. Now, one of the things about it is that of course they could use software and AI and vibe coding to create some type of tool that inspects x-rays, like looks at the x-ray and it's like, interesting, this.
Take the role of the medical professional.
Yeah. Which has been the play for a long time, like that you would replace a radiologist because that's what Pro Medicus' software does. But it's important to understand that you can't just vibe code your way into the Mayo
into
Clinic.
a hospital. You never know. Who knows? You set up an avatar and send it in. Maybe they can meet in the metaverse.
Maybe
and then
Optimus will be in there and be like, oh yes, right this way, AI. But seriously, this is what Pro Medicus' CEO said. I love the way Pro Medicus does their ASX reporting. For any CEOs listening today, they always do this Q&A with the CEO, Sam Huppert. And Sam, I don't know who this anonymous journalist is, but Richard Allen, this one, from Oxygen Financial Services or Public Relations. He asked the questions that a shareholder would want to ask, and they put it out as an actual ASX announcement. And one of them was around, there's been a lot of talk about the impact of AI in recent months, which has seen a very dramatic lowering of share prices of software companies. This has been attributed to huge CapEx expenditure and the disruptive role of AI in programming, such as vibe coding. What, if any, impact do you foresee it will have on Pro Medicus? And I'll give you the Cliff Notes version. So the second concern is a belief held by some that new AI tools will radically disrupt software development with vibe coding, helping destroy the IP mode of all software and SaaS providers. They claim everyone will be able to use AI tools to write industry-grade software in a fraction of the time. This, in our view, is an overly simplistic generalization, one that certainly doesn't apply to us. Visage 7, which is their primary tool, was built from the ground up using our own proprietary technology. It is not based on some readily available toolkit or platform. It is very specialized, highly technical, patented suite of software that incorporates more than 30 years of domain knowledge. It is not a product that can be easily replicated with or without AI.
Sounds like it's replicable.
Yeah, maybe this will spook people. We have not left a roadmap for others to follow. I think, then he goes on to say some other things about, the hospitals and stuff. I think that this was actually, it seemed like quite an emotional piece of text, because this is just written. I'm just reading verbatim what it says. He goes on to say, also, let's not forget these AI tools are available to us as well. Our developers have been using AI for quite a while. You can't just go, quote unquote, hey, Claude, sit back and wait for the industry-grade software to be produced. The tools are not that sophisticated. What they do allow is highly skilled developers to focus on system design rather than coding. They are at their most effective when used by a small, highly skilled development team, which is exactly what we are at Visage, which I agree with, to be honest.
Is this just the market buying into a narrative? Like the headlines, you've still got another multiple all-time highs across markets all over the country, but stocks just being smashed by headlines. Like a headline about Claude released not just the vibe coding, the co-work space, the legal business line as well, where basically they're getting rid of the juniors in a law firm or the junior analysts in an investment bank. Is it just buying into a narrative and stocks are getting smashed as a result without real evidence?
I think one of the things with these ones is that it's undoubted that Pro Medicus is one of the most valuable companies on the ASX, and it's one of the highest quality, if not the highest quality companies. But that doesn't mean that it's worth
100 times,
300 times price earnings ratio.
Yeah.
So even after today's fall, it's 100 times.
Yeah.
So at what point does it become really effective? I would say it's probably...
But it's still growing at 30%.
Yeah. Oh, and its profits growing wicked fast.
Margin.
I don't know. Just full disclosure, my cost base is like $7. It's still $135. There's a point where I would consider buying this. It's probably not today, but it's if the 20% fall happening, and I'd start to get really interested.
It's never on the first sell-off. If I've learnt anything in my multiple catching falling knives, if you could see my hands, you'd see holes all over.
Trust me, I'm really bad at this.
It's don't buy it on the first drop. CSL is the perfect example. The trigger, as soon as something like CSL happens, you just want to go after it. You want to top up. But as much as you don't, you call this vibe investing, maybe vibe coding,
maybe, yeah.
But you just in terms of the kind of qualitative, when something like that happens with a company, they had an abandoned M&A, then it's natural some management change is going to happen. It took 9 months, probably longer than most people expected. So they had another downgrade and the CEO left, and now vibe-wise, it's still a quality company, still consistent earnings. It starts to look attractive because there isn't much more bad news that can come in.
True.
Like at some point, you run out of sellers, I think is the key here. And when does it happen for different companies?
Yeah, true. All right, I want to play a little bit of Who Am I, right?
Your old mate Jensen Huang is supportive of you too.
Assuming
AI will replace entire businesses is the most illogical thing in the world. Well, he has to say that.
That's probably the most conviction Jensen's ever had in anything. Normally he says, I don't know the answer to that. And then just proceeds to say nothing. So, who am I? I'm a US technology company.
Better.
At the end of 2021, my share price was $150.
Yes.
By the end of 2022, my share price was $88.
Yes. Palantir.
I'm involved in AI.
Palantir.
I would be considered the world leader in AI right now.
World leader. Oh, Google, Alphabet.
So when ChatGPT first launched, everyone was like,
they sacked Google.
Holy shit.
Good that R rating back.
ChatGPT's going to destroy us. And then everyone just totally threw the baby out with the bathwater. Subsequently, it goes from $88 to over $300. And
we
it's now
talked
the
about this.
number one in the
I
world.
think it was a few months ago too, wasn't it? Where we just said, Google is going to be the ultimate winner from AI. They've got all the history. They've got all the data. They've got all the documents. They've got
The users, they got everything. They
Try
got the
using
server
Copilot.
farms. They've got their own chips. So yeah, even at the beginning of 2025, it went from $205 down to $150 in 3 months.
Yeah.
And now it's back, like it's doubled. And it's crazy how quick sentiment can turn. And when you're in these high growth industries, how fast and how ferocious it is on the downside. Like it's really wild. Now, I don't know if the same thing will happen with Pro Medicus and all these types of companies, but you would have to say if Pro Medicus has 73% profit margins, is growing at 30% a year and has done for over a decade, and it sells to the stickiest client base in the world, like it's...
Your two questions: is growth slowing? No, growth's not slowing.
No.
Will AI change the growth trajectory? Probably not. If you think about it, like you have to create a product and then get it approved and then get it through all these.
You have to physically install it
into these hospitals as well,
and train people, which is, I mean, if it was just like a web app and it was just like, cool, but I just don't. I don't know. Here's a question for you. So you use Claude a lot. I don't use, other than for coding, I don't really use Claude, but everyone in our team has been, not everyone, but a few of them have been going on about Claude Co-work.
Yep.
Have you been using that?
No, not at all.
Okay, never mind then.
I use Claude for everything, but I don't even know how Co-work works. I'm a bit of a Luddite when it comes to AI.
Well, my theory is going to be like, my question, I guess, my hypothetical is going to be, how long until people question even companies like Microsoft?
Yeah. I think they already are. Look at the share price. Dropped 12% on a report.
Yeah. But it owns literally everything. It owns
It doesn't
Planet
help.
Earth.
It owns OpenAI, but
Yeah.
more and more people, like the more positive you hear about Claude, and apparently the Super Bowl was just full of ads, AI ads against each other.
Yeah.
And it's
So good.
I mean, I think just because you have AI doesn't mean they're gonna win.
Also a related theme, I saw a headline this week that when the Super Bowl was on, it was one of the record days for people calling in sick to work.
We just put it on the projector in the office, keep everyone in.
Oh, right.
It's much
Okay.
easier.
Locked them in. Yeah. Now you actually, other than me just playing it, who am I with you with Alphabet or Google, you do have some hypotheticals.
I do indeed. They're quite, I felt quite timely, and they're kind of anti-momentum, you could think. The first one, this is silver, and this has been everywhere. Silver did exceptionally well in December, January, not so much February.
Yep.
So if you're one of those people who was lined up outside the bullion centre in Sydney or Melbourne, and highly publicised on Instagram, LinkedIn, all those places, everyone's using them for their own story.
They are indeed.
Or that series of articles that said it's a changing paradigm. Everyone has to have silver or gold in their portfolios now. But if you bought silver in 2025 or late 2025, what are you doing now?
I don't know. Just as a side note, I don't actually...
You can't pull out another Instagram
think
video
I'm-
for this one.
I think I'm in a different 4chan thread than the one that involves silver, because I missed the memo on silver.
Is it just another meme stock thing?
Because it's a piece of shit. And
It feels like a meme stock rally.
like gold has some sort of like quantifiable correlation with risk and all this stuff, but silver's just like a meh thing.
Yeah.
Like, no offense to anyone that owns it. I mean, maybe a little bit, but
Like gold bugs, you can turn
I
silver
would
into a
just
story.
sell it and go and do something better with my life.
Yeah, I mean, what was the
What
premise
would
of
you
buying
do?
in the first place?
What was the
Sell it and buy gold?
sell it? I'd at least buy gold.
Yeah, because you can try and justify industrial uses and all that sort of thing.
And
but it's
central bank buying, like I haven't heard, maybe
clearly speculative. in
maybe
silver.
the central banks are buying silver these
Yeah.
days, but I haven't seen that. I
no.
haven't seen it anywhere.
And it just shows you that the media cycle, as things go better and better, they get more profile, and as they go worse and worse, they get more coverage as well. So it's hard to be just tracking along in the middle of the road, getting 8, 9, 10% per annum. But like the S&P 500 or most portfolios are,
Yeah.
all the attention's on adding silver or cutting silver, or the tech stocks that are getting smashed at any point in time. I thought that was, I don't know many people who bought it, to be honest.
You do?
I don't. I
No,
don't.
no. Yeah, I think it's a different community than the one that we are in. But I showed you that video last week of that guy that was offering Hershey's bars or $900 worth of silver, and every single person took the Hershey's chocolate.
As soon as I put on the Today Show, the silver price, and it's gone retail.
And I guess if that same dude had offered, instead of a bar of silver, a bar of gold,
100%.
everyone would just take the gold,
$7
right?
grand there.
Yeah, that's it. They would take the gold because they know the value of it. Whereas the silver, it's like, meh, whatever. What else you got?
Another one was more about the market and how the market's sitting at the moment. So you've just deployed today. You put 20% of your portfolio in IVV. You could even say you put in IOZ, A200. So say it's in ASX index or US index.
Yep.
What are you doing now?
Well, I'd be holding on to it. Is that what you mean?
Are you topping up? Are you worried?
If I had more money.
Like if you went from cash, let's just assume you went from cash into
like
markets.
day one.
Yeah.
That'd be hard. I just say try and hold steady because it wouldn't be easy. But you would have a lot of retiree clients that, there'd be some retiring every month in the wattle business, and you would have had people experience this.
I mean, a lot of the time we're going like for like. They're already invested into reasonably diversified, and we're deploying it into a diversified portfolio. Yeah. But I mean, when you're in periods like this is when some value in deploying cash, large amounts of cash into the market and in multiple markets needs to be either stepped out. We actually have a section we call stepping into markets.
Stepping in?
It's like dollar cost averaging, but in terms that most people understand and can kind of appreciate. And then it's all the other levers. So if I bought the IVV, I'm probably looking for diversification, or I should be buying a few other things at the same time, not just relying on one.
Yeah, that's a red flag if someone's just putting it all into one investment, isn't it? But that's, Jamie, your business partner, always emphasizes this idea, which is that it doesn't really matter what the market's doing if you're in a diversified portfolio.
Yeah.
And I've seen that with our Terra strategy, like Terra Firma. Our Terra strategy has performed very, very well over the past 12 months, but our really high growth funds haven't.
Yeah.
And that's to be expected because we've had a lot of volatility over the past year. But I think we spoke about this like mid to late last year. We got a lot of questions come through, which we do have some for today as well, which is great. So we'll get to them in a minute. But we had these questions come through. If you had all this money now, what would you do with it? And I think both of us were saying, just go into a balanced portfolio. Because at the time, it was we're not oracles, but it was pretty clear.
It's a bit of apart from Andrew Dermott and his interest rate calls, we're oracles and a lot of other things.
Actually, last week we got it completely wrong. We recorded on the day of the... Well, definitely you. Yeah. I was trying to diversify.
Stay with you on that one.
Yeah.
Let's go deep on that one.
Yeah, but I just think that if you're in a balanced portfolio, it gives you the option to redeploy capital.
Yeah.
Like right now, like my thought is that it would make sense to diversify now if you had IVV into, we have IHVV.
Yeah.
Same ETF, just with currency hedging. Or if you've got that, then maybe have some bonds or some floating rate.
Yeah.
Simple stuff.
I've a good hypothetical for you, and this might be too simple, but who knows? If someone offered you 7% return for life with zero volatility, would you take it?
For an investment portfolio?
Yeah. Amount of capital aside. That means, would you, or do you really want the ride of equities and the potential for 30% returns? And maybe you could ask this to Owen, the 30-year-old.
Yeah.
And Owen, the 60-year-old.
30-year-old Owen. Well, it's not all of my wealth. It's just my portfolio, right?
Yeah, sure.
Then 60-year-old would definitely take it.
Yeah.
Definitely. Wouldn't you?
Yeah.
If you drew at 60?
I mean, if you can achieve 7% and you can, via fairly diversified portfolio, you can get it, obviously, with volatility. Yeah.
There may be some tax and inflation eaten into that, but yeah. But if you were younger,
30s, would you take
it's harder.
Yeah.
I don't know if I would.
It's going to double every rule of 7, isn't it?
11 years.
Yeah.
Yeah. What would you do?
I would not take it. I'm not in my 30s anymore, so it's probably past me.
You look beautiful.
In my retirement, for sure. Like if you can get 7% guaranteed. The problem with getting 7% guaranteed in real life is that it usually starts at 7, then it goes down to 3 at some point.
Actually,
yeah.
Just had a thought. If you gave me 7% guaranteed, and I'd
probably structure a product to do that if you want.
If I could get leverage at 5%,
turn it into 14.
At 5%, I would gear it up as much as I could go. Claim the tax, claim the interest on the debt as tax deduction.
Okay, Macquarie Bank.
Yeah, and you call me an investment banker. But Yeah, so you wouldn't take it. I don't know if I would take it. But that said, if someone was to say, hey, dude, just take the 7% for the rest of your life, there's a big tail end of that as well, which is by the time you get to 60 and 70 and 80 and 90 and whatever, that's pretty amazing. I think, though, we've spoken a lot about this, I think generally asset class returns across the board are slowly coming down.
Yeah.
I think that over time we'll continue to see that.
You'll have some potentially going up.
Yeah, like you'll have emerging markets that are no longer emerging markets, like China, I'd imagine, start to yield better results.
I still can't get over the RBA last week.
So
still sitting on me at the moment.
Chuck on your Andrew Dermuth hat. You haven't published any new real estate videos this week for your new firm.
New kitchens. Waiting for the kitchen renovation.
Dermuth, what is it? Realty or something like that? Yeah, something like that.
LLC.
That's it. Selling Sunsets 2.0. So I can't really talk to you about that, but I can get you to reflect on the RBA's call, given that you on the show so adamantly said there's no way in hell that they're raising interest rates.
Bit of hyperbole there.
And then the RBA said, up yours, Dermuth.
There you go.
They raised the rates.
So apparently the RBA is now data dependent because they weren't data dependent before. Yeah, we just don't worry about the data. We vibe policy.
Vibe code our way to.
I think maybe they were vibe policing before, but who knows? But it's still, I just don't understand. I mean, we went a little bit political. You went a bit political last week, but we went a bit political, and it's the RBA refuses to talk about government spending and its impact on inflation. And I think we covered it on the Australian Retirement Podcast, which is the amount of government spending on infrastructure and construction is crowding out the private sector, which is sending prices up significantly. And the biggest increase in inflation was in housing.
Yeah.
And we sit here and go, solution? Higher interest rates. There was a good, someone came out with a reasonably good, I think it was Capital Economics came out with a reasonably good article, which said a lot of the work was already done by the Australian dollar rallying ahead of that meeting, where that becomes an automatic stabilizer. It seems short-sighted. Like, I don't see the RBA having to being forced to make decisions. There was nothing wrong with keeping rates as they were. It was, you just still don't know if it was a single or multiple pieces of data. And if the currencies increase, why don't you wait until to see what impact that has on the next set of inflation figures before you hike? Yeah. I think it's almost, and this is one word I hate when it comes to politics, which is credibility. Credibility. Apparently the RBA feels like if they didn't hike because so many economists were predicting it because there was so much media attention and pressure that they lose credibility. That everyone's saying you should do it. This was I think it was a guy from Capital Economics. I can't remember his can't remember what his name was. I can put in the links in the show notes though. Dr. Gerald Ford. Yeah. But it was basically that. Don't put Gerald in trouble. Dr. Ford, doctorate in economics. Yep. But essentially, and this is what happened during the pandemic and all different times where everyone questions the credibility or the independence of the RBA, which let's not get into that. But if they don't make the decision that everyone expects, then they're not credible anymore. Yeah. Or if they make a decision that's in line with what the government of the time wants, it's not independent. Like all these things I just think there's so much focus and headlines about these decisions where it wouldn't surprise me if they have to cut in 12 months' time. Yeah. Like you're hiking with no productivity growth, with no labour problems, with a currency that's going up, and with inflation in property, essentially. And that's it. And booze, but, Yeah. We've got a problem. I think we do. So maybe I'll just retire from making calls on interest rates. So let's get one more call out of you before you retire. So your view is that by the end of this year, will interest rates be higher, lower, or where they are? I'm going to be safe and say where they are. They're going to stay where they are? Yeah. Okay. I feel like that's safe because I normally say cut. Watch that not happen. Yeah. Okay. So just for those listening for the first time, in the early stages of the post-pandemic economy, I was predicting, was it no interest rate hikes? No interest rate hikes. A cut rather than a hike. Yeah. For a period of time, not for the whole time, for a period of time. And I stuck to it for a few months longer than I should have. And then interest rates went way up. Yeah. And then I think you were saying they might even continue or stay where they are and they got cut. But that's okay. We trust you. Not a trained economist. We inverse Kramer, inverse Meredith. It's the same thing. And I stick to my calls. I don't change them every week. Yeah. So
I tend to flip-flop.
No, I'm talking to the economists.
Oh, yeah, that too. If you what's your layer them all end to end around the world, you wouldn't reach a conclusion.
What's our annualized inflation rate?
You figure that out.
14.7%.
You phone a friend while I dial into the Stock Genius game, the share market game of 2026, which is available at stockgenius.com.au. It's the game that's running in 2026, brought to you by Rask and Nevexa. We have over 2,000 hopefuls, some sad lost souls who decided to put their portfolio together for public display. And we can now see who is any good and who is not. I can tell you for sure that I am not any good according to this game. But of the leaderboard, we have Crypto Short at number 1. Keeping in mind that this game only started recording about 10 days ago, is already up 55%. Imperium is up 43%. And Jim is up 29%. Thanks, Jim.
That's not James from the retirement podcast, is it?
Oh, there's some great names in here, by the way.
Are we at a crypto winter?
No ideas back. Huh?
Is this a crypto winter?
It could be. Elon Tusk is number 11, so I'm going for you, Elon Tusk. Triple J is in at number 8. Shock and Awe, Shoot Investor, Sleep Up. There's some good names in here.
It's bad that I'm doing better than Drew's Porsche. Is part of the names in here.
I'm just happy that if I beat the other half, and I can tell you for sure that I am not beating her. So I am currently, I've moved up spots. Number 1,845. What are you?
770 something.
Wow, you're doing pretty good.
I'm doing pretty well, yeah. Ingersoll Rand helped me up for a little while there, but tanked pretty quickly.
The AI play that does compressors.
Yeah, and I doubled down on WiseTech, which helped me last year.
7.7% is what I'm down.
Yeah.
But there's some...
It's a long game. So, what happens, you know how short these crypto winters can be. So that could turn around and it could be negative 200%
True.
at the end of the year.
True.
That's the problem with shorts.
You never know.
Yeah. I can't believe you allowed short crypto on this platform. I guess it's not you.
You got to do what you got to do. Fraser's actually doing pretty well. Yeah. So you can see that it's a bit of a laugh. You can also join the conversation at community.rask.com.au. One way you can also just let us know how you're feeling and send in all your emotional ideas and question marks is via the link in your podcast player or in the YouTube description. It's also found at rask.com.au/question. And there you can ask questions for the weekend show, which is the show today, and we'll answer them. If you select the Australian Investors Podcast, we do have some questions coming up in just a moment. Before we get to them, our general advice disclaimer: any of the questions or answers or even the content that we produce here at Rask is strictly general in nature. We don't know your needs, goals, or objectives. So be sure to speak to a financial advisor, like say the Honourable Drew here, before you act on the information. If you want to know more about what general advice is or the things that Rask does or doesn't do, you can head to rask.com.au/legal, where we have something called a financial services guide, or FSG. We do have a personal advice business here at Rask, but we do not give personal advice on podcasts. Go for
Big news too, because we recorded early in the week last week, and later in that week, big policy proposal came forward, cutting the CGT, the discount on capital gains tax.
Yeah.
By 50, from 50% to potentially lower. And more news came out this week, which talked about it only applying to property investments. I thought that was pretty significant too. Something like 80 or 90% of the benefit, the tax lost by the government, as we call it.
Yep.
If they could have taxed it, but they lost money somehow. We're straying a lot into politics at the moment.
We're very political this year.
Retirement bonuses that we talked about, where they're getting the money back that you on the retirement podcast, that if you've had tax deducted that you don't need to pay, and you get a bonus by getting it back.
Yeah,
I thought that was great marketing. I don't mind it. If it helps support investment into other investments outside property, I think it's a positive. I kind of think about this, and maybe it's too philosophical, but when you invest into companies, you're investing into kind of living, evolving institutions. When you invest into property, you've got scarcity in the land, if you've got land, and a depreciating asset sitting on top of it in the asset. And it doesn't employ anyone. It doesn't sit barely, not very much anyway. Not like investing into shares. So why would you get the same discount on the capital gains and encourage people to invest more in property? And that's natural, because you can leverage and the value of property is higher, so you can get more of a benefit and you get more discount from it. So I don't mind it. It's going to be big and it's going to be a massive change, but it sounds pretty likely at the moment.
So anti-property.
But also a real estate agent on TikTok.
Yeah.
I'm just a conundrum.
Yeah. He's a lost puppy.
Yeah. That's huge.
But seriously.
Yeah.
Chances of it actually proceeding?
It sounds, I mean, you've got a massive Labor majority and you've got spills happening in the Liberal Party.
Yeah. And
One Nation surging. It's like seriously, they can pass it. So, and they raised it in 2019. I looked at the numbers. It's basically on a $500,000 gain, you would pay $40,000 more in tax if it went from a 50% discount to a 1/3 discount.
Do you think
superannuation?
Do you think their property Illuminati actually think about that stuff, or do you think they just buy and then
deal with that later?
Just charge more for the house later on.
Just increase the value by more.
Just
no one wants to pay tax. I think that's
what's changed. I'll just increase the price of my property.
Yeah.
But
I mean, there'll be all kinds of grandfathering, and we've had it in 1999 where they reset the cost base as of. That's likely what will happen. I can't see them going, from today, any capital gains now gets less of a discount. No, it's like, we'll index it to this date, and then you'll have inflation adjusted from this point forward, and just give the accountants or the AI accountants another leg of work they have to do when properties are sold in the next 4 decades.
Yeah, they'll just grandfather it like they did with the old CGT rules from pre-91.
Yeah, and they won't raise the $247 billion that they talked about.
Well, I think I don't want to take the words out of his mouth or put them in them because I don't actually know. But I'm pretty sure my good friend Scott Phillips often talks about this on the old Twitter feeds. He was saying that I think indexation is probably the policy that makes the most sense for this type of thing rather than just a flat out discount.
Which they did in, you were saying 99?
I think they cut it.
Reset it.
Yeah, I think it was some 90s or something.
Yeah.
Where
Good time.
Well,
Good time
great
Radio.
time. We got some music playing from the 90s out there. Early 2000s and 90s. Those are the days.
But so in that case, then the cost base would be increased by inflation or whatever average weekly time earnings, whatever they decided, unless another massive jump in inflation comes. Yep. So you'd take that cost base off as opposed to just the cost base you paid for it.
Exactly, yeah.
Just feels like an unproductive asset that gets a massive tax benefit.
It does, yeah. But I mean, Labor tried to do that with negative gearing and it didn't really work. Yeah. So maybe they can do it now because, like you said, everything's in a disarray. And speaking of which, I'm
seeing more and more people sell property too.
I'm hoping to get this guy on the podcast one day, Mr. Malcolm Turnbull. But he had this, he was outside, I think it was Parliament House earlier this week, and he gave this announcement.
Well, he'd be worried about it.
Here we go. I'll see if I can pop this in the microphone.
This is the inevitable consequence for the Liberal Party of imagining that the goal of politics is to seek the approval of the Sky News audience. Now, that may well represent many of the members of their branches, but it does not represent Australia. Australia is a sensible nation. We are a balanced, we are centrists as Australians. We have an electoral system that mediates our political conflict at the centre because of compulsory voting and preferential voting. And if you run off into La La Land, which is where they've headed...
Get him on the pod. We're going straight too far into politics.
Get him on.
We're going to need a 3.5-hour episode to go with Malcolm.
Yeah.
Made most of his money out of funds management though, didn't he?
Yeah, I mean,
and property.
There's some pretty... If you go back through the archives, there's some pretty wealthy politicians in Australia, let's be honest. But I think that's the kind of clinch point, though. Like, if there's no strong opposition of the kind of classical style of economics and whatever and business thinking, then you would think that the Labor Party has more of a chance to get these types of policies up.
Yeah, and Treasury's already has done the numbers.
Yeah, but that same Treasury also said that house prices would only increase by 0.5% when they brought in that stupid 5% rule, which we all know how I feel about that. So
it's all right if you got 7 townhouses.
Here we go. Increase, like, no deposits, and then it will cut the CGT. So, which is it?
I don't know.
But anyway.
Pull both.
Yeah, that's it.
Why not pull both?
Gas pedal and brake at the same time. But yeah, if it gets through, it's going to be interesting. And I think, personally, obviously, I think that I 100% agree with you, Drew, that investing into a company produces jobs, and then it has ripple effects of the company will then be able to invest in other assets that maybe have more productive uses, and you get this whole supply chain. Whereas a dormant asset or an asset that's even just in care and maintenance, like most properties are, you don't have that same value creation, that same value chain from injecting money.
Lucky we're not on the property podcast, because I'm sure we'll get plenty of feedback about it.
Oh, we'd get feedback on YouTube if we were on there. But we don't. We're pretty classy over here.
We could probably insert 7 different companies here. Maybe I'll use it. Knife on a cliff. I'm going to use this question 7 times. Okay. Is WiseTech a falling knife? Is CSL a falling knife? Is AMP a falling knife? Well, is car sales a falling knife? Is Pro Medicus a falling knife? We can do all 5 quickly.
Okay, so this was a question from, who was it again?
Knife on a cliff.
Knife on a cliff.
If I want to buy it, yes, it is.
Of those companies, I think falling knife would be AMP.
Yes.
And falling knife, maybe not a falling knife, but I'd say that CSL is up for debate.
Yeah.
The others, I would say, will get interesting at some point. I just don't know what point. Why is car sales under so much pressure? I asked someone, really?
AI, yeah.
I asked someone on Twitter the other day and they didn't really know.
Just AI.
They did buy the shares without knowing the answer to that though. Anyway.
I think if you're not telling everyone how you're integrating AI, even if you're not, or you're not doing it properly, or you're like a lot of business where you're trying it and it's helping in some areas, then you're going to get smashed when you go and report. I think you've got a reporting season thing coming up on
we do. On Monday night.
Yeah.
We'll put a link in the show notes.
In live.
Rask.au, while you're at the gym with Khan.
We do that in the mornings, not at night. Yeah.
Rask.au/season, and we're doing a webinar on Monday night, and there'll be another one in a fortnight's time and another one at the end of reporting season. Totally free.
If you're not talking about AI in your earnings report this quarter, you're going to get smashed. If you're anything involved in digital or technology.
Sam from Pro Medicus talked about it a lot.
Yeah, but I think I
think maybe he was going
rowing against the tide on that one.
You should have just said, it's amazing.
But you think about it, we're not really pricing any productivity, but then some of the most old-fashioned businesses are probably going to win the most out of AI. The Woolworths, the Coles, they've already been using automation, but you add an AI level to all of the the back office and the distribution things that they're doing. That's why I think the Dow Jones and the value stocks have been doing much better in the last kind of month or so.
Definitely, yeah.
And it could switch again.
The thing is, though, I think that we made this point maybe last week or something, or late last year, that eventually you've got to understand where the competitive pressure is and where it's not. And for something, so say like Claude, which you mentioned before, which is the AI tool, or ChatGPT, or any of these things, even if Commonwealth Bank is going to use one of these tools, so the biggest or second biggest company in Australia, and they're benefiting from that, as you say, eventually the pricing power is with ChatGPT or Claude or whatever, not with CBA.
Yeah.
So eventually, the value will no longer accrue to CBA. Eventually, the benefits will be outweighed by the cost. And at that point is when you don't want to be playing into that narrative for too long. I don't think we're a long way for that. I think the value of AI is amazing. It's going to create huge productivity benefits for probably 10 years to come. But there will come a time when it's not going to do that. I actually had the opposite thesis on these falling knives, quote unquote. I think companies like Pro Medicus and that sort of stuff actually have the benefit of having a head start.
Yeah.
Because they can now roll off new features and these types of things faster.
Yeah.
And if they already have the brand and the customers, the incremental cost of adding a feature is so much less now. And they don't have to use a lot of AI to do that. Whereas, say, Commonwealth Bank or ANZ, who we mentioned earlier, up 8% today, want to fire 1,000 developers because they're like, nah, I don't really like that. Well, that's a big deal, right?
Yeah.
And they would have to invest so much into AI to get that same productivity uplift. Whereas Pro Medicus doesn't have to do that. They've got a number of developers you can count on 2 hands, probably.
I reckon I'm almost ready on CSL and WiseTech.
What's still on CSL?
Yeah.
Okay.
Well, we didn't trigger a buy when it first hit last year.
Okay.
And it's because there's always, whenever there's something like that, there's issues at management level. Management's going to be about to change. That's why the stock tanked and earnings are slowed. Usually the new CEO will come in and cut more stuff. He may not do it straight away, given how big the company is. So we're close on that. WiseTech, similar. It hasn't really done much. I mean, it's fallen further, but hasn't really shown much sign of recovery. I think it's stabilised maybe. Pro Medicus, there was nothing wrong with earnings, so
very good.
Yeah, I wouldn't be worried about that. Car sales likely a bit more challenging. And I put one more else in there. AMP, yeah, it's
AMP.
falling off.
Yeah.
Like their wealth their platform business, so they're looking at buying CFS apparently.
Really?
In the news today. Yep.
Oh, wow. Well, that'd probably be decent for them.
Yeah. It's bigger than them.
Oh, is it really?
Yeah.
Oh, okay. Never mind then. So CSL is looking like it's coming down for landing, Drew.
Yeah.
Has not been a pretty 12
holder.
months for it. Down from over $300 to 150.
Yeah.
I feel like there's a bit of a wager in the waters here.
All right, I'm in.
Okay. CSL, I'll take WiseTech.
Oh, who's going to do better? Oh, I like both.
Okay, then I'll take Pro Medicus versus... Oh,
No, we do CSL WiseTech. Let's go.
Okay,
let's do it.
okay.
Yep, done.
I bet you CSL will do worse than WiseTech.
Yeah, I'm an optimist, so I would say CSL.
Okay, I'm putting this down in my notes. I'm like,
We'll grow
okay, so Drew
by
is
31 December.
CSL, 31 December. Owen
Should we do it
is-
earlier so we can talk about it live as the market closes?
Christmas.
Yeah.
2026. You gotcha. And if you have any feedback for us on that, ladies and gents, let us know who will be right and who will be wrong. Banter is very welcome. We've got some more questions, Drew. Who is up next?
We got bag and equity. Did I miss something there?
What?
I don't, bag and equity. When we read these out, sometimes we haven't looked at it all that much, and it's kind of, I'm worried that it's one of those inappropriate ones, like IP freely and things like that from The Simpsons.
There's been some bloody crackers over the time.
This one, interesting. Should I buy a commercial property, childcare, or commercial property in general, or a house to rent invest?
What do you think?
It depends. I haven't said this for a while, but it depends.
Commercial property, childcare,
usually high income, not
or a
necessarily
house
high growth.
to rent vest.
Yeah.
Okay, it depends. I guess what's the purpose of this person?
Generally, when
doing
yeah, exactly. Are you looking to get growth over a long period of time? Are you looking for tax benefits in terms of negative gearing, or are you looking for depreciation benefits? So, like buying a commercial property is usually higher income. If it's childcare, usually the rental yield is higher. The depreciation benefits, if it's new, are higher. But the growth potential in commercial property tends to be, unless it's developable.
Yep, that's a word.
It's the Scrabble book. The growth tends to be lower. So is it a risk that you're just standing still when you do something like this?
Yeah.
Rent vesting tends to work when you rent something and then you buy a property that you're renting out and leverage more using that. And you can actually get more leverage in residential property than you can in commercial property generally.
Yeah.
It's usually 80% or 90% under your 80%, 90% for first home buyers, or 95% for first home buyers.
95% first home buyers.
But 60 to 65% at best for a commercial property in most cases.
Yeah. It's interesting.
Yeah. So you prioritise income or growth.
Maybe really just do the numbers and get some independent advice. Even if you don't want to see a financial planner to help with this, maybe even a good accountant, like a good accountant that can help you understand like the costs involved in this type of a thing. Commercial property is not as liquid as you might think. So there is a risk around being able to sell it. And a lot of the times, the biggest probably scam I see in this part of the market is because it's commercial property, it's a bit unregulated, even more so than residential property, is a lot of the kind of fake leases that go into the commercial properties. So people who are selling you like a warehouse or something like this, the real estate agent and the seller has really no legal obligation to be really fully transparent with you. Yep. It's like buyer beware, basically. And so you really want to test the veracity of the underlying lease agreements, if there is for that commercial property, who the tenant is, if they're related to anyone, including the real estate agent or the owner, the current owner, because those things all determine the ultimate value. I've heard some really alarming stories recently of some of the bigger groups that push a lot of volume through commercial property. They tend to get a lot of this crappy stock that comes through, and oftentimes it's a business owner that currently owns like a little warehouse or commercial office or something, and they're the tenant in there. So they bought it years ago to be the tenant, pay themselves rent, and then they sell it a year or two before they know they're exiting.
Yeah.
And they don't tell anyone because they don't have to.
Sell
the property, and then in a year or two the lease expires and you've got no way to re-let that. So that will just destroy your carrying value. So really hard question to answer, but commercial property can be great. Conversely, it's a 7% income right there.
You know who's good at putting together spreadsheets to help analyse that?
James?
Claude.
Oh,
Sorry, James.
because James did the
Yeah, he did
the
a really
episode
good one,
with the
SMSF.
plus.
Yeah, they've got a
remember?
lot of feedback on
Yeah.
that. I bring it up all the time.
Yeah, he got in the AFR
Yeah,
for that.
yeah.
He got a whole opinion piece.
And why
in
would you
there.
leverage in a low tax environment? That's the whole point. Unless
Yeah.
it's in, volatility decay. I even explained that last week too.
Wow.
Uh,
There's a question here. Alert but not
Yeah.
alarmed.
I was going to go to this one next. Yeah. Perplexed by LHGG.
Mm-hmm.
In a strong market, Lake House Global Growth.
Mm-hmm.
In a strong market, it's down 28% in the last 12 months. I assume to December. That's usually when they update. Maybe it's to today. Any reflection/concerns?
Yeah, and it's directed at me because we own this.
And it's not a loan. Let's be clear on that either.
I think it's fair to be concerned. I think I was concerned for a while. Lake House has a very, very, very concentrated portfolio. So the way they run is they have X number of names, but the top 5 positions account for the overwhelming majority.
17 at the moment.
Yeah. So even 17 though as a whole is quite concentrated. Like there's not many stocks, but then the weightings of those top 5 is significant. I saw a bit of a note about this in I think it was the December quarter or something like this, where they said that on average the stocks in the portfolio were down something like 20%.
Yeah.
But on average, I think it was free cash flow or the underlying earnings was up 20%.
Yeah.
So again, we're seeing that dichotomy between falling share prices and rising profitability. And for those of you that haven't been investing that long, it can be very uncomfortable. But as long as that relationship remains intact, share prices falling or flatlining and profitability increasing, what that means is it's only a matter of time before the profitability increasing outweighs the downside of the falling shares. Now, this is a growth fund. So whenever you see growth fund in the title or growth strategy or something like this, you can almost bet your bottom dollar that the kind of stocks that are in there are the high growth, fast growing types of businesses that are highly valued.
Yeah.
They're the ones that get sold off first when the market gets a bit wobbly. So that's what we've seen. We had it at a very small position, Drew. If anything, and together with the whole Pro Medicus, Xero, and these types of things get sold off, if anything, I'm kind of the opposite.
You buy it.
I'm starting to, I don't want to say that we're doing it now, but I am. This is the number one thing on my mind is at what point do we sell some of our bonds and sell some of our other stuff like our ASX 300, our IVV ETFs. At what point do I redeploy that capital back into these types of companies?
And rebalance. Yeah.
I think we're not that far away from it, to be honest.
I think you have to know what you own. This is a high conviction strategy. We use high conviction strategies too. And when you have high conviction, that means, anywhere from 10 to 20 stocks, and there's 69% in the top 10 holdings. So more concentrated than the S&P 500,
Yeah,
but
way more.
actively managed. Where as soon as you do that, the potential of positive 30% returns and negative 30% returns increase significantly.
Yep.
Whether the strategy goes out of style, there'll be multiple. There's a couple in our portfolio. They're not as swingy as much of this, but they're well behind benchmark, like significantly behind benchmark.
Yep.
And the question we always have whenever you go to a manager, and naturally advising clients for 20 years, the first questions are the ones that are underperforming.
Yeah.
It's not the ones that have done well. It's always the ones that are underperforming.
Of course, yeah.
And our question is, one, has the manager changed their approach? Has there, we bought them because we wanted their expertise and experience in loyalty in the case of Lake House and intellectual property. We don't have them in our portfolio. We've got something probably similar. Has their approach and their view changed? Yes or no? No, it hasn't changed. Has that market perception of this approach changed? No, I don't feel like that's changed either. I think the momentum's just turned against SaaS companies as they've talked about, in which case everything is staying as is. And if you weren't aware of the risk when you started with it, then it's not necessarily suitable to every portfolio. And then it's about position sizing. As you said, you've got a smaller holding in it. You've got a larger holding in the index. The more diversified than this and more and less volatile index. So it's position sizing. And whenever you've got high conviction, if you know you're making the bet, you put more into it. If you are wary of that volatility, then you have it as a satellite position within a global share, whether it's Aussie or global.
Yeah, it's a good point. Yeah, it's a really good point. iShares S&P 500 ETF, currency hedged, is up 15% over the past year, while Lakehouse is down. So this just goes back to the very top of the show where you talked about, if you had 20% put in today and it fell or something like this. This is the exact time where you go, I've got a diversified portfolio. This thing that I hold is down, and then you run through Drew's questions. Yes, they're still doing the same thing. Yes, that's the reason that I bought them. Yes, they still own these companies. Okay, that's all consistent. Well, according to your plan, it's rebalance. And that can be really hard for people because you're selling a winner to go into a loser, which sounds counterintuitive. One of the hypotheticals that Drew had for me today, don't want to give too much away for your secret sauce for next week, Drew, but I saw his notes.
They're shared notes.
And one of the hypotheticals was what's like one phrase or something, or like what's one belief or myth, or what was the actual question?
If you could eliminate one piece of conventional investing wisdom, so like a rule that everyone quotes, that you think does more harm than good, what would it be?
I think it's phrases like buy low, sell high, and these types of things. But
don't trade at all.
I just think for most, like when we talk about stocks, that's where the buy low, sell high thing comes from, and I think it makes sense to keep buying higher. But in the case of diversified portfolios, that kind of makes sense. Is you're rebalancing, and that can be really uncomfortable because typically you're doing it at the time when there's the least amount of certainty. Like we don't know what's happening with AI. We don't know if Pro Medicus is any good. We don't know if cloud and all that stuff's valuable. We don't know if Claude's going to be better than ChatGPT or whatever the case may be. So,
and you don't know if it's high or low when you're buying it either.
Well, that's it.
For a specific stock, when you're doing a diversified portfolio rebalancing, it doesn't matter if it's high or low.
No, that's right. So, as we wrap up today's show, good Drew, I think we need a call for a dad joke from you.
We do indeed.
And we would love to hear more of your questions. Drew just said, actually, now this could be a myth, but Drew just said that they've just bought another big box of his book. What's it called?
The Golden Years.
The Golden Years.
Yeah. How to live a fruitful and successful retirement.
There you go. Something about fruit. If you write in a question next week for us here on the 2 Cents program of the Australian Investors Podcast, we'll send you one of these books. Assuming Drew's got them under his desk. So write your questions in via the link in your podcast player. It's just the /question on rask.com.au. Likewise, if you want to kind of come and ask questions live, Monday night at 7 or 7:30, there'll be a link in the podcast player or in your YouTube description that takes you through to our first of 3 reporting season kind of updates. And we'll do some Q&A. We'll cover the most popular companies from the ASX reporting season that is currently underway. I can tell you that I'll be talking about Pro Medicus, Temple & Webster, maybe even ANZ if it gets a Guernsey. But there's been some really interesting companies come out lately. Even Northern Star Resources came out this morning with a pretty good result. So lots of good companies reporting at the moment and lots of opportunity for sure. So that's in your podcast player. Drew, as always is the case, Drew from Wattle Partners, wattlepartners.com.au. What is your dad joke? You're giggling away.
I asked for AI-related dad jokes.
Yeah.
I'm not sure how it's going to go down. My AI's love language is predictive text.
That's pretty good. Yeah. That's pretty good.
Mind that one.
I had a joke, but it's not actually a joke. It's more of a punchline.
Is it appropriate?
Yeah, it is. So I went and bought. I think it's me and Google. I went and bought Gemini Ultra.
Yes. Oh, yeah. Upgrade.
So it's like $500 a month.
Does it come with a badge?
No. Oh, yeah, it says Alpha in the top right corner. And as in Alpha Male, I think. So I asked it a question. I was like, shit, let's give this thing must be like 10 times better than anything else out there. It's so expensive. So I went and tested it out in a form. And I've got it right here. What did I ask it? So I said in a big Google Doc that I knew had spelling mistakes in it. I said, are there any grammatical or spelling errors in this document? Don't write anything, just tell me. And it said, yes.
Oh, worth the $500 just for that. That's a better dad joke than mine.
That was great. I'm like, that really worked. So thanks for that, Gemini. But seriously, if you get the chance to use the Gemini Ultra or Gemini Pro service and you go to something like, I think it's called Whisk. I don't know if you've seen Whisk, but Whisk is like this animated AI lab. And the stuff that you can create there is just mind-boggling. Like, I can't, it's just it's incredible. You just got to go use it.
Yeah.
So some really cool stuff. Well, AI might be bringing down our stocks, but at the same time, there's some really interesting things happening. We'd love to hear more from you and work with you. You can head to the community.rask.com.au, or you can head over to Waddle Partners at waddlepartners.com.au. Drew's also available on TikTok. He's got a new real estate channel going there too, so don't forget to give him a follow. But Drew, Meredith, always a pleasure, mate.
Good to see you.
Thanks for watching this episode of the podcast. If you want to hear more from us, you can get daily videos and podcasts on Rask's YouTube channel. Or if you want to enroll in a free course on investing, property, business, money, you name it, you can join over 34,000 other students and enroll in a free course on the Rask website. Simply head to www.rask.com.au and follow the prompts. Thanks for watching this Rask podcast.